On December 16, 2025, the FDIC proved the rules that fundamentally change how stablecoins are integrated within the US banking ecosystem. If you are holding crypto with any institutional time frame, this isn't a regular noise. This is an infrastructure shift that will determine which platform will survive in next cycle. I'm Saleh. This channel will cover macro crypto analysis for serious investors. Today we are breaking down the Genius Act implementation rules, not the politics or not the price speculation, the actual banking mechanics that will affect where your stablecoin can be held, how they are backed, and which institutions can actually custody them. This matters because FDIC just finalized the 4-tier framework that goes live in Q1 2026. We will cover what each tier means, which institutions qualify, and specific implications on how you interacted centralized exchanges, DeFi platforms, and institutional custody platforms. What is Genius Act? For the context, the Genius Act, guiding and establishing national innovation for US stablecoins, was signed in law on July 18, 2025. This is the first comprehensive federal stablecoin legislation in US history. 3 critical things. 1. It creates federal regulatory framework for payment stablecoins. These are defined as digital assets pegged to the US dollar and intended for the payments, not algorithmic stablecoins, not DeFi governance tokens, specifically dollar-backed stablecoins like USDC and PyUSDC. 2. It establishes reserve requirements. Issuers must back stablecoins one-to-one with high-quality liquidity assets, US Treasury bills, overnight repos, and insured deposits. No commercial papers, no corporate bonds, no rehypothecation. 3. It assigns regulatory authority. The OCC supervises national banks issuing stablecoins. The Federal Reserve supervises state-chartered banks, and the FDIC gets oversight on deposit insurance implications. What happened on December 16th was the FDIC finalizing their specific piece, the rule governing how banks can custody, issue, and integrate stablecoins into the traditional banking systems. Now the FDIC rules. The implication framework create 4 tier of banking institutions, each with different permissions and requirements for stablecoin activities. Tier 1, nationally chartered banks with full authorization. These are the institutions like JPMorgan Chase, Bank of America, BNY Mellon, systematically important banks with federal charters under the new rule. They can issue their own payment stablecoins, provide custody service for third-party stablecoins, offer stablecoin-linked deposit accounts, and operate as reserve custodians for other issuers. Requirements: enhanced capital buffer, 2% additional tier 1 capital for stablecoin liabilities, real-time reserve attestation systems, full compliancy with bank secrecy and AML rules at the individual wallet level for custodian services. Tier 2, state-chartered banks with the Federal Reserve supervision. Institutions like Signature Bank successors, Silvergate potential replacement entities, State Bank with Federal Reserve master accounts. They can custody third-party stablecoins, operate as a payment rails for stablecoin transfers, and at last hold reserves for licensed issuers. Requirements: 1.5% additional capital allocation, monthly reserve audits by Federal Reserve examiners, limited to custodial stablecoins from federally licensed issuers only. Tier 3, licensed non-bank stablecoin issuers. This is Circle, Paxos, potentially PayPal under their money transmitter licenses upgraded to federal stablecoin licenses. They can issue payment stablecoins, contract with the Tier 1 or Tier 2 banks for reserve custody, operate redemption mechanism directly with the users. Requirements: they cannot take deposits, they must maintain 100% reserves plus an additional 2% capital buffer in liquid assets, weekly third-party attestation, annual full scope audits by FDIC approved firms. Tier 4, custody-only trust companies. Think Anchorage Digital, BitGo under their state trust charters. They can provide qualified custody for stablecoins, cannot issue stablecoins, cannot integrate with fractional reserve banking. Requirements: full reserve custody, no rehypothecation, daily proof of reserves, and segregated omnibus accounts for each client. The key insight: this creates a regulated pathway where institutional money can hold stablecoins through FDIC supervised entities without the legal ambiguity that existed for past 5 years. Crypto banking implications. So what does this mean for how you actually interact with crypto platforms? Implication 1. Centralized exchange custody. Exchanges like Coinbase, Kraken, Gemini, they are not banks. Under the Genius Act, if they want to hold customer stablecoins, they need to partner with the Tier 1 or Tier 2 institutions for the actual custody. We are already seeing this. Coinbase announced their partnership with BNY Mellon in October for institutional stablecoin custody. What this means for retail investors? Your USDC on Coinbase isn't held by Coinbase directly. It's held by BNY Mellon in a segregated omnibus account with Coinbase operating the interface. The benefit: the stablecoins are now within FDIC supervisory perimeter, not FDIC insured. That's a common misconception, but supervised, audited, and subject to the same capital and reserve rules as traditional banking deposits. Implication 2. DeFi protocol integration. This is where it gets complex. DeFi protocols are not supervised entities. The FDIC rules can't directly regulate Aave, Compound, or Uniswap. However, the stablecoin used in DeFi must come from Tier 3 license issuers. Circle has already stated that USDC will be only minted through their Tier 3 license starting from Q1 of 2026. The practical effect: you can still use USDC in DeFi protocols, but Circle has now regulatory obligations. If DeFi protocols are sanctioned, Circle can freeze USDC at the smart contract level. We saw that technical capability with the Tornado Cash freezes in 2022. Now there is explicit legal framework requiring it. Implication 3. Institutional on-ramp. This is the biggest unlock. Pension funds, endorsements, RIAs managing client assets, they have been legally barred from material stablecoins exposure due to custody rule ambiguity. With Tier 1 banks able to offer stablecoin custody under FDIC supervision, the custodial path is now clear. A pension fund can now hold USDC through BNY Mellon's Tier 1 custody services, and their compliance team can check the box. We already seen the allocation committees at Family Office approves 1 to 3% of stablecoin treasury bill equivalent positions for Q1 of 2026. That's not a speculative crypto exposure. That's institutions using stablecoins for what they designed for: dollar-denominated settlement rails. Investment implications. Let's connect this to actual investment positioning. First, centralized stablecoin issuer consolidation. If you are analyzing this sector, the Tier 3 licensing requirements create significant moats. Circle, Paxos, and PayPal already have the money transmitter licenses in most states and existing banking relationships. A new entrant would need to obtain 50 plus state MTLs plus a federal stablecoin license, and it need to establish custody agreements with Tier 1 or Tier 2 banks, and need to build real-time attestation infrastructure, and at last post a 2% capital buffer on top of full reserves. Circle's current market positioning: USDC is 24% of the stablecoin market at 58 billion and likely to expand again. Tether USDT is at 65% market share, but they offshore. If institutions want regulatory compliant exposure, USDC become default choice. Investment thesis: platforms integrated with Circle issuers infrastructure see expanded institutional adoption. That's Coinbase, that's Angrok, that's integration partners like Stablecoin using USDC for international settlement. Second, bank issued stablecoins are coming. JPMorgan already have JPM coin for wholesale clients, 1 billion daily volume. Under Tier 1 authorization, they can expand to retail. Same for BOFA, Welfogo, State Street. The question isn't if, it's when. My read, Q2 of 2026. They will wait for the OCC to approve the first major retail banking stablecoin application, likely JPMorgan. Then everyone else follows within 90 days. What this means: bank issued stablecoins compete directly with Circle and Paxos, but only for custody and payments. They are not entering crypto native use cases like DeFi and DEXs, liquidity and cross-chain bridges. That should still remain as a Circle domination. Third, exchanges with institutional custody will win. If you are evaluating centralized exchanges, the differentiator is custodial infrastructure. Coinbase has BNY Mellon, Gemini has State Street relationships, and Kalkan is working on the partnership right now. Exchange without Tier 1 or Tier 2 banking relationships will struggle to onboard institutional clients under the new framework. This matter for customer acquisition costs, margin profiles for which platforms pension funds approves. It's not an investment advice, it's a data point. The exchanges building supervised custody rails are the ones institutional allocators can use in 2026. Timeline and what to watch. The FDIC rules were approved in December 16, 2025. Here is what happens next. January 15, 2026, public comment period ends on final implication details. This is mostly procedural. Major framework is locked. February 1, 2026, OCC begins accepting Tier 1 banking applications for stablecoin issuance and custody services. March 2026, institutions must declare their tier classifications. Existing stablecoins operators not in compliance must wind down or partner with licensed entities. Q1 of 2026, first Tier 3 expected to be issued. Circle, Paxos likely the first approvals. Q2 of 2026, first bank issued retail stablecoins expected to launch and pending OCC approval. What to watch? 1. Circle's license application approval. If they get Tier 3 status in January or February, that signals that institutional flows into USDC will accelerate. Watch the press release from State Street and BNY Mellon about expanded stablecoin custody services. That's the practical indicator that money is moving. 2. JPMorgan's retail stablecoin application. When, not if, they file with OCC, that confirms banks issued stablecoins are the next phase. Watch for the executive statements from JPMorgan's digital asset division in Q1. 3. DeFi protocol adjustments. Major protocols will implement issuer verification. Aave, Compound, Curve will likely require stablecoins to originate from licensed Tier 3 issuers. Watch governance approval in January and February. This is in the price moving info in the short term. This is an infrastructure that rails that determine which platform can serve institutional client in 2026 and beyond. Conclusion. Bottom line. The Genius Act implication isn't about stablecoin prices. It is about regulatory clarity for institutional infrastructures. The FDIC's 4-tier framework creates a supervised pathway for banks custody, issue, and integrate stablecoins into traditional finance. For investors with institutional timeframes, this is the development that determines which platforms can function pension funds, which issuers can scale into regulated markets, and which exchanges become primary on-ramps for next wave of capital. We are moving from crypto-native stablecoin usages to bank-integrated stablecoin infrastructure. That shift happens in Q1 and Q2 of 2026. If you found this breakdown useful, subscribe for macro analysis. We cover Fed policies and ETF flows, regulatory developments, and market cycle timing for serious investors. No price predictions, just data-driven education. Thank you for watching. I'll see you in the next one.